Hi and welcome to another episode here on the channel. The latest US inflation data is in, and we see an increase of 2.8% from last year the same period, and expectations were 2.7%, so it's a bit worse than that, and we see already an impact in the market. The target for inflation is 2%, so this is a bit above what the Federal Reserve want the inflation to be. And this, what will this mean? It will probably mean that we are not going to expect any lowering of the interest rates in the future. So mortgage rates, etc., will stay at the same level as now. So that's like the short-term effect of it. It will not get more cheap than now for the moment to loan money for companies and for also as personal loans, etc. So in a way, this makes it harder to have fiscal policies that will get the economy going. So maybe you want the economy to grow more. You maybe the government want to do some government programs. You might want to cut taxes, etc., just to keep the economy going. But if the inflation is like stuck at a higher rate than you want, then you can't be as aggressive on your fiscal policies. And that can be a problem, because if you're locked in like a place where the economy doesn't grow very much, like we have, for example, in England and starting to have in the USA, maybe you want to have some government programs like spending programs to get the economy going. But if you're stuck at a higher level of inflation, you are kind of can't do that type of investment because that will spur inflation. So it's not an ideal situation overall for the marketplace short term here. Hopefully we can see some price decreases over time, but it's quite uncertain going forward, because we have a lot of taxes on trade going up, etc. So short term we might not see the immediate effect of lower inflation. We also expect a lot of defense military spending, for example, in Europe. That will definitely not lower inflation. So yeah, that's kind of the short-term analysis here. We want the inflation to go down a bit, and also, I mean, if the inflation is still like over 3% or almost 3%, depending how you look at it. If you count all items less food and energy, it's 3.1%, and all items overall inflation is 2.8% in the US. So most people are probably not getting more pay raise than 3%. So it's like they're not getting any wealthier, meaning they will not be able to buy more than they are doing right now. So we want the salaries to go up faster than inflation, at least if you are working. Anyway, if we dive a bit deeper regarding what type of products that are really getting mostly inflated here, we can see that utility, like piped gas service, are 6%, and also transportation services are 6%. So that's like a lot of inflation here. Shelter is 4.2%. Other services, less energy, is 4.1%. Food away from home, like restaurants, is 3.7%. So it's more expensive to eat out. And if that's like 3.7% inflated, and salaries are not getting up as fast, people will eat less out, meaning restaurants will have decreased in their profit margins, and they might have to cut some jobs, etc. So that's not a positive thing. We will see if restaurants have and other places where you eat out have the capabilities to lower prices, or if this is like a situation where we're stuck with an unwanted situation. So yeah, it's not optimal. Energy services as a whole, 3.3% inflation, up 3.3% in comparison with 1 year ago. So yeah, food 2.6% compared to the same period as of February last year. So this is like the whole February that we see here. Some people might think that 2.6% for food sounds a bit low. I don't know. This is like official US numbers for inflation. Obviously, we still have like the whole like food price increase during the pandemic, and that price increases hasn't like came back down. So if you had like 25% increase in a certain food, maybe 2022, 2023, and that price hasn't gone down, we still will have a problem to afford that new price. So it's a 2.5% on that new price. So this is why maybe the increase in food prices doesn't seem so high, but maybe we wanted actually a decrease in some of the core metrics here. So that's probably why a lot of people are disappointed, because it's not like salaries has gone up 30-40% like the last 3 years. So it's probably hard for many people to keep the same standard of living as they had before. And obviously the inflation issue is all around the world after the pandemic. A lot of money printing are still drive the inflation and are still affecting us. The GDP to debt ratio, how much the government are having in loans, are a lot higher now than it was like 5 to 6 years ago in most countries, and that still affects us. So that's problematic. We have some decreases, like some energy, like fuel, oil. So at least some decreases here, but not too many, unfortunately. But hopefully we can push this number down a bit going into the future, and we can get the salaries up so people get a bit more resilient and can have money to spend on and get and in that way get more out of their life. So that's like what I want to talk about mainly today. It will be very interesting to watch the numbers for March, April, and May, when a lot of the policies we have now are getting more steam. And will the new taxes on trade, will that lead to companies making their prices go up, or will they kind of lose their profit margins? Usually they put higher prices and the consumer are getting the brunt of it, but if the consumers doesn't have more money, then we might be in another situation. So that will be very interesting to see. And also, to get the inflation away, we need to avoid like wars, etc. in parts of the world where we have a lot of food, for example, and energy supply. So that could be something that if war, for example, the Ukraine war ends, we can get a bit lower inflation, at least in Europe, and that can affect like South America and USA also, because everything is interconnected. So that's my take on it. So if we are in the stock market, I wouldn't like change my stance here, because in the end of the day, if inflation is high, the value of the dollar in your pocket are getting lower, but if you own asset, the value of the asset will still rise. So it's usually a good thing to own assets if you can afford it during periods of inflation. So I want to say that just 0.1% difference in the inflation versus expectations here today is something that should affect your portfolio. But if you are an expert in macroeconomy and you have done your due diligence and want to sell based on the market going down like 1 or 2%, you can do that. You have to make your own choices. I would just say I'm a long-term investor and I will not sell anything based on today's numbers. Usually it's very, very hard to make money just based on inflation numbers, etc. You need to have a broader sense of understanding and long-term horizon in your investments to make more money than you would have if you, for example, just have your money in an index fund, etc. So that's my take on the inflation data as of today. And hopefully you enjoyed the content. And if you have something you want me to dive deeper into, or you want any educational material, just write to me and I will focus on that. And I see you next time. Thank you very much.